Many of you have asked me about my opinion on Microsoft. Microsoft went down a little bit after reporting earnings. The stock is still down 14% year to date. It's been really, really bad for Microsoft. But Microsoft is an amazing company. You're getting Microsoft 365, LinkedIn, which I believe has a moat, a competitive advantage. Very high margins, by the way. They're growing 17% year on year. You have Azure growing 30% year on year. Then you have Xbox and personal computing, which hasn't really been doing too well. But the earnings report wasn't really bad at all. The company put in 427 versus 406, and they also beat on revenues. So it was a really good quarter, especially for Microsoft Azure. Microsoft Azure grew 40% on a constant currency basis, and the analysts, they were expecting 37%. So if you look at all those numbers, you believe that the stock should be up like 5, 7, 8, maybe 10% like Google. But no, it's down like 4% after reporting earnings. It's been really crazy for Microsoft. Now, if you look at the RPO, which is the performance obligations, or you could say future revenues or backlog for the cloud related business, it's sitting at $633 billion. It's up about a 99% or 100% year over year. But if you want to exclude OpenAI, the backlog alone without OpenAI has grown about 26% over the last quarter, which is pretty amazing as Microsoft is diversifying away from OpenAI. And I told you guys before that the OpenAI thing is more of a call option right now. It's not really the main thesis with Microsoft, as the stock is trading below the valuation of where OpenAI even launched. So a lot of it is getting priced in. But even if you exclude OpenAI and you assume OpenAI goes to zero, the backlog is still sitting at a pretty decent level and is growing 26% year on year. So again, Microsoft is diversifying away, and I really like what the company is doing. Now, even for the AI related stuff and mainly Copilot, which people likes to hate on, well, now the company has 20 million seats, up from 15 million seats in January. They grew about 5 million seats. That's not bad at all. Still a little bit slow, but it's a progress. It's not really bad. And again, Microsoft, they have the resources, they have the reach, they have the networks, they have the bundling effects to cross-sell Copilot and even give it out like they did with Microsoft Teams, and they put in Zoom out of business. Zoom barely grows 2 to 3% revenues because Microsoft has the networks, they have the bundling effect, and they gave them Team for free. I believe over time, Copilot could serve the same purpose as Team, but it could potentially generate pretty decent revenue for the company in general. They said weekly engagement is now at the same level as Outlook, which is amazing, and more users make Copilot a habit. And more people have been using it. I've been getting good feedback. So that's really, really good. Now, the best part of it all, just like Meta, but Microsoft's headcount has actually gone down year over year. So when you have a company growing 15, 17% revenues, 30% in Azure revenues, you normally have a higher headcount because you need more staff to do a lot more things. And whenever revenue grows, normally staff grows 15, 17% in line with revenues. But in the case of Microsoft, it's actually going down. So it shows you the efficiencies from AI that the company is seeing within its own enterprise, but also the AI potential revenues from Azure and from so many different products. So a lot of their investments have been paying off, but the market still doesn't like the CapEx spending. They guided $190 billion on CapEx, which is up 61% versus 2025, and the expectation was $154 billion. So it pretty much destroyed all expectations, largely due to much higher memory-related prices. Now, this is what I'm going to say about CapEx. And I don't think I have to say much, because if you look at this chart, you're going to understand what I'm saying. If you look at this one, which is cash from operations or operating cash flow, do you notice how fast it has been increasing after the company started increasing CapEx? So here they didn't really increase CapEx too much. It was kind of flattish, grew a little bit, nothing too crazy. But look at the pace of the growth here whenever the company started increasing CapEx. Now, what does this tell you? It tells you that this CapEx is generating much more revenues. The company is spending the CapEx, and they already have the revenue booked through the RPO, through the backlog. backlog. So they're not like gambling the money away and hoping maybe the metaverse is gonna pay off or something's gonna pay off. They already have the contracts. They just have to spend the money to satisfy the contracts and make 630 billion over the next few years from the backlog alone. But the market is not liking the capex. I mean, what are they doing with the capex? And is it actually producing results? If you look at the pace of growth in operating cash flow after they increased capex, it's absolutely mind-blowing. And the best part about it is they can pull back this capex tomorrow by 50%, and the cash from operations will still be 170 billion. So they can decide to stop this anytime. They can decide this to expand free cash flow anytime they want. They could do it tonight, they could do it tomorrow, they could do it next week, and ultimately they're gonna do it. But if they're finding a way to generate explosive growth in cash from operations, why would they really slow it down? Why would they, you could say, not invest if they're seeing the opportunity to invest and grow? And whenever, this kind of goal is reached, they're going to stabilize capex a little bit like they've done before. This is not the first time again. And once they stabilize the capex, you're going to have massively growing free cash flows. The free cash flow is going to explode overnight pretty much. And then the market realizes that it's a great company, or it's a good opportunity. So I'm not really understanding the price action around a lot of those magnificent seven. It's like the market is saying, or the investors believe this is permanent, but it's actually temporary, and they can pull it back anytime. And Azure would still be here, and LinkedIn would still be here. Those companies, they don't need 97 billion in maintenance capex. Maintenance capex is like 5 or 10 billion, I would guess, maybe 15 billion maximum. But the 97 billion and 190 billion, all of this stuff is to grow, is not really for any maintenance capex. But if you look at the valuation again, it's trading at about 23 times earnings, as low as it was near the 2022 bottom. This is really low for Microsoft. If you look at my valuation model, I'm using the current fiscal year 2026, which they have 1 quarter left. Expectations is 1703. So I put in 1703, then I put in 16% compounded in earnings per share growth. I believe 15 to 16% is fair for Microsoft. They have grown 19, 20, 24% previously, but I'm using 16%. I think it's fair. The main multiple is about 24 right now. It's not 23, but it's 24. I use 24. So same multiple, no expansion, no contraction, and a tiny, tiny dividend. All in all, I got about $858 per share, or 115% on the upside, or about a 17% annual return on such a mega cap, amazing company like Microsoft. I mean, that doesn't happen very often. I've been analyzing those big seven stocks for a few years right now, and I barely see a chance to get it double over the next 5 years. In this way, I'm seeing 17% potentially annual return on an amazing company like Microsoft. And again, that doesn't happen very often. And when it went to 360, 370, my chart was saying a 21% annual return. So again, this is why I bought the dip on Microsoft. I think it's an amazing company, and I think the stock's undervalued. And that was my opinion on Microsoft. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.